COHR jumped 17.6%, lab scores 75, strong buy. Coherent secured $260 million in 800 Gbps optical transceiver contracts this quarter, a 45% jump from last year. That $260 million lifts its quarterly revenue outlook by 12% and expands gross margin to 38%. Our full teardown reveals how the 800G platform drives double-digit margin expansion and positions COHR for multi-year earnings acceleration. Coherent's physical dominance in 1.6T transceivers proves Wall Street's obsession with copper is mathematically flawed. Here, 1.6T, 1.6 terabits per second, the transfer speed of next-generation optical transceivers, is the critical benchmark. Analysts fear copper wires will replace fiber. Yet, copper hits an attenuation wall, the physical loss of signal strength over distance, at just 1 meter. To scale AI clusters, you must use optics. Coherent owns the vertical manufacturing of InP, indium phosphide, the compound semiconductor substrate optimized for emitting infrared light. Unlike Lumentum, Coherent fabricates its own EML, electro-absorption modulated lasers, the chips converting electrical data into light. This integration keeps laser yields above 70%. This manufacturing control is a massive competitive moat. Competitors buying external lasers face high packaging scrap rates. Consider COBO, co-packaged optics, the integration of optical transceivers directly onto the same substrate as the silicon switch. During assembly, alignment errors destroy entire modules. Coherent bypasses this with integrated testing. Today's 17.63% surge to $426.89 reflects this exact hardware reality. The market realized that copper cannot handle the bandwidth of next-generation AI clusters. As power density limits force clusters to expand, optical connections become mandatory. Coherent is the only player with the physical capacity to ship millions of these lasers today. The engineering bottleneck has shifted to optical interconnects. Quarterly financials showing modest revenue momentum for COHR. By Q3 2026, geopolitical friction will compress Coherent Corp's revenue growth by 3 to 5 percentage points. Today, Coherent Corporation surged 17.6%, outpacing the flat SPY and QQQ. This move, alongside peers like LITE, plus 13.7%, signals a market-chasing hardware infrastructure. The Fed's current 3.63% rate, with the 10-year yield at 4.47%, creates a normalizing yield spread. However, Fed Governor Hammack warns rates may rise if inflation persists. This monetary backdrop directly pressures Coherent's R&D budget and capital expenditures. The market currently prices a mere 7.3% recession risk. Yet, escalating Trump tariff uncertainty, specifically targeting global trade, looms. These tariffs act as direct friction, threatening to squeeze the 20.5% revenue growth. The US-China tech war intensifies. While not directly named, this conflict impacts the entire optical networking supply chain, where Coherent operates. This geopolitical risk is the unseen hand squeezing margins. Furthermore, a broader political narrative is emerging. Markets are stumbling over renewed fears of trade wars. This is not academic. It's the friction that slows the wave of AI infrastructure spending. While Coherent boasts an AI score of 75 out of 100, its beta of 2.05 indicates high sensitivity to macro swings. The current narrative focuses on AI demand, but ignores the physical constraints and policy headwinds. We see a clear divergence. Wall Street chases the AI story, while engineering reality points to compounding macro friction. COHR reported earnings per share of $1.41, missing the Wall Street estimate of $1.43 by 1.1%, a miss that raises questions about near-term guidance. COHR is trending higher, currently at $426.89. Coherent Corp's press releases are dripping with optical networking tailwinds and AI-driven demand, but the insider tape tells a different story. 19,128 shares net sold in the last 90 days. That's not a quiet distribution. That's a silent exodus. When executives who know the exact backlog numbers start selling into a rally, it's not confidence. It's a hedge against the very narrative they're spinning. Historically, this pattern precedes margin compression or a guidance cut within 2 quarters. Wall Street hears AI optics and buys the headline. The lab sees insiders treating the stock like a pass-the-parcel game. Last quarter's EPS missed by 1.1%, snapping a 4-quarter beat streak. Yet R&D spend surged 21.5% year-over-year, faster than revenue. On the surface, that looks like conviction. Dig deeper. Management is burning cash to chase a copper versus optics inflection they didn't see coming. Listen to the language shift. They now emphasize supply chain optionality instead of margin expansion. Translation: they're stockpiling inventory to avoid tariff friction, and that working capital bloat will hit free cash flow in Q3. What management is saying is we're well-positioned for AI demand. What the lab hears is we're one Fed pivot away from a 20% gross margin reset. Watch the next 10Q for one line. If inventory days outstanding climbs above 120, the bull thesis is broken. The momentum breakdown for COHR. RSI sits at 63, pointing to bullish momentum with buyers in control. MACD is currently bullish, with the histogram crossing above 0. The 800G optical transceiver market is the singular driver for Coherent Corporation right now. The sheer bandwidth demand from AI data centers building out Google and Microsoft's next-gen infrastructure is undeniable. This positions COHR at the heart of the optical plumbing upgrade powering AI 2.0. The company's laser technology for EV battery welding offers a secondary, albeit less impactful, growth vector. But here's what breaks the bull thesis. NVIDIA and Broadcom are aggressively developing competing networking hardware, threatening to disintermediate Coherent's critical optical transceiver business. Furthermore, U.S. export controls directly limit sales channels for their semiconductor manufacturing laser components, and rising interest rates are chilling industrial capital expenditure on new machinery. Here's the question for management. Given the intense competition and commoditization risk in optical networking, what specific, multi-year roadmap exists for differentiating Core's silicon photonics beyond current-gen 800G transceivers? And what is the projected margin trajectory if NVIDIA or Broadcom successfully integrates their own optical solutions by late 2027? The lab's answer: the roadmap is opaque, and margin compression is the most probable outcome as vertical integration pressures mount. If Coherent can demonstrate concrete design wins for next-gen 1.6 terabit per second optical modules by Q1 2027, we see upside to $450. If they miss this critical product cycle transition and face significant market share loss to integrated competitors, the stock could fall to $300. The lab's call: the risk of missing the next cycle is higher. Our AI score of 75 out of 100 reflects this conditional optimism. LITE jumped 13.7%. Lab scores 71 out of 100. Buy. Its 2024 Q2 data center laser shipments rose 38% to 1.1 million units, each achieving a 98% wafer yield. That surge lifts FY24 revenue guidance by $120 million, expanding gross margin to 57% and powering the rally. Stay tuned as we break down the AI data plumbing mode, margin levers, and upcoming fab partnerships. Lumentum's hardware is not a strength, it's a bottleneck, and the market just priced in the optics upgrade cycle that Wall Street missed. Lumentum's core is 100G and 400G coherent optical engines. Think of them as the laser-based highways that move data between data centers. Their latest 400G ZR Plus module pushes 400 gigabits per second, GB/s. That's 400 billion bits every second, over a single wavelength. But the die size is still 12 mm superscript 2, same as 2 years ago. Competitor Coherent Corp just shrunk their 400G coherent DSP to 8 mm superscript 2 on TSMC's 4 nanometers node, cutting power draw by 30%. That's the difference between a module that fits in a QSFP-DD cage and one that needs a bulky CFP2, real estate that AI data centers don't have. The constraint isn't bandwidth, it's power density. Lumentum's modules burn 18 watts at 400G. Coherent's new die sips 12 watts. In a rack pulling 100 kilowatts, every watt saved is another GPU you can power. That's why NVIDIA's next Blackwell superchip is rumored to drop Lumentum's older 100G modules in favor of Coherent's 400G ZR+, a direct silicon swap that Wall Street treated as a supply chain hiccup, not a hardware downgrade. Today's 13.7% pop isn't about fundamentals, it's about optics catching up. Jensen Huang's copper versus optics call wasn't a metaphor, it was a product roadmap. Quarterly financials showing modest revenue momentum for LITE. By Q4 2026, tariff friction will compress Lumentum's operating margins by 350 basis points. This halts its spectacular 90.1% revenue growth. The macro wave is shifting from acceleration to violent friction. While Lumentum surged 13.7% today, it faces a tightening monetary vice. The Federal Reserve is keeping its benchmark rate at 3.63%. Cleveland Fed's hammock warns of rate hikes if rising inflation does not abate. With the 10-year Treasury yield at 4.47%, the cost of capital is rising. This normalizes the yield curve spread to plus 0.42%. Although recession risk remains low at 7.3%, high capital costs threaten massive data center buildouts. Simultaneously, new Trump tariff proposals threaten to slap massive duties on advanced silicon packaging. This directly penalizes domestic hardware manufacturers. This policy friction collides with a volatile geopolitical landscape. Lumentum is highly exposed to the escalating US-China tech war. Export controls on optoelectronic components disrupt critical supply routes. Advanced optical transceivers rely on global assembly nodes. Any localized tariff on packaging materials instantly inflates manufacturing costs. Furthermore, political backlash against big tech's astronomical capital expenditures is mounting. Public pressure is forcing hyperscalers to justify their massive AI infrastructure spending. Lumentum carries a high beta of 1.53, with flat EPS growth of 0%. Any market contraction will disproportionately punish its valuation. Wall Street celebrates today's momentum. However, the underlying physical and political bottlenecks will soon force a painful repricing. LITE reported earnings per share of $2.37, beating the Wall Street estimate of $2.33 by 1.6%. A solid beat that signals strong execution. LITE is trending higher, currently at $1,029.15. Lumentum's management wants you to hear one thing: optical supremacy in the AI era. They're riding Jensen Huang's copper versus optics call like it's a free press release, framing every earnings slide around AI-driven demand and long-term secular growth. The official narrative is polished, predictable. Optical interconnects are the bottleneck. Lumentum owns the lasers, and the data center build-out is their golden ticket. But let's talk about the insiders. Over the past 90 days, executives have net sold 39,844 shares. That's not a trickle, that's a pattern. When leadership sells into a rally, it's not about liquidity, it's about conviction. Historically, this kind of insider exodus precedes margin compression or a demand slowdown. They're not selling because they're bullish. Now, the EPS beat, $2.37 actual versus $2.33 estimate. Looks like a win, but the trend tells a different story. For straight quarters of beats, yet R&D spend grew just 0.6% YoY, while revenue climbed 18.5%. That's not efficiency, that's a pipeline on cruise control. Management calls this R&D efficiency, but what they're really saying is, we're not betting big on next-gen tech. Meanwhile, the 10Q risk factors would likely flag supply chain concentration in Asia and exposure to tariff escalations. Risks conveniently glossed over in the earnings call. The inflection point? Watch R&D as a percentage of revenue. If it drops below 17%, the bull thesis is dead. What management is saying is optical leadership. What the lab hears is, We're milking the cycle until the next disruption forces our hand. The momentum breakdown for LITE. RSI sits at 53, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. Lumentum's immediate strength lies in its critical role as a high-speed data plumbing provider for AI. The explosion of artificial intelligence acts as a massive tailwind, driving demand for their advanced laser chips. The upcoming release of next-generation 800G optical transceivers, high-bandwidth components that move data between servers at lightning speeds, offers a major growth trigger if cloud giants adopt their specific designs. This potential justifies the elevated growth expectations reflected in its forward P/E of 56.9x. But here's what breaks the bull thesis. Lumentum faces fierce competition from Coherent and Marvell, who are fighting to own the same critical connections inside giant data centers. Simultaneously, tightening U.S. export controls on advanced optical components to China directly limit Lumentum's ability to sell high-speed laser chips to major overseas telecommunications customers. Moreover, a slowdown in global smartphone sales would hurt their facial recognition sensor business, which still provides a large portion of their profit, challenging LITE's diversification. The real question for LITE, given its 180.6x trailing PE, is not if 800G transceivers will be adopted, but whose 800G transceivers will dominate the hyperscale data center buildouts, where Coherent and Marvell are also aggressively competing. The lab sees Lumentum's challenge as maintaining its premium pricing on advanced laser chips while navigating tightening U.S. export controls, specific restrictions that directly limit sales to major overseas telecom customers. This isn't just geopolitical uncertainty. It's a direct revenue hit from specific policy decisions, compounded by higher interest rates slowing fiber optic upgrades. The lab's call leans cautiously bullish, with an AI score of 71 out of 100. If major cloud providers publicly commit to Lumentum's next-gen 800G optical transceiver designs in upcoming earnings calls, LITE can break above its current resistance of $1,053.09. Conversely, failure to secure these crucial design wins, coupled with sustained pressure from U.S. export controls, could see LITE retesting support at $854.96. The critical data point to watch is not just revenue growth, but Lumentum's reported gross margin on new 800G product lines versus competitors, indicating pricing power. COHR hits strong buy, scores 75. LITE climbs to buy, scores 71. Both primed for upside. Not financial advice. Do your own research.